everyone, and thank you for watching my videos. In the previous video, we took the first step in developing your investment strategy. Now, what I want to do in this video is to help you develop your trading style. You see, developing a trading style is important because in order to be a successful investor, you need to know how much time you're willing to commit to the Forex market, because the two most valuable assets of every trader is the assets of time and experience. So when we open up our demo accounts and we trade with our virtual money, we can gain some valuable experience, and we can transfer that experience as well as everything that we've learned when we trade with real money. So it's very important to know how much time you're willing to commit, because by knowing how much time you're willing to commit, we can develop a strategy that's right only for you. Okay, so here are some things to consider when we are trying to develop our trading style. We need to know how much time we're willing to invest in getting this information. Information on Forex market developments, news releases, as well as market prices of other commodities and current events. You see, we need to get this information from all of these categories and apply that before we open any position. That's our fundamental analysis. However, how much time can we spend on getting this information? Well, it also depends on which type of trading style do you prefer to use. Now, there are four types of traders. There are scalpers, there are day traders. Also, we have swing traders and position traders. How do we distinguish these four types of traders? Through the amount of time they commit to the Forex market. Some people can only commit a small amount of time. Some people can commit 10, 12, or 14 hours a day. But it all depends on your personality, your lifestyle, and what events are going on in your life that you can develop a schedule to where you can handle what's important in your life and take time to make trades in the Forex market and analyze the Forex market. Hopefully you're analyzing the Forex market before you make your trades. Okay, so let's talk about the first type of trader, which is the scalper. Here's what we need to know about scalping. Scalping means you hold on to trades for an extremely short period of time, even only for a few minutes. What you're doing here is you're just jumping into the market, looking for whatever easy profit that you can get. You get that easy profit and then you jump out. It's only a small amount of profit, but as you jump in and out of the market, you're accumulating small amounts of profit, and that adds up to a big gain at the end of the day. However, that involves a large amount of time that you must invest, such as maybe you have to invest somewhere between 8 hours a day or maybe even 16 hours a day. But either way, you are glued in front of that computer like a hawk. And that could be very difficult for most people to do. So think about that before you decide which style is right for you. Also, how do we know whether or not you're a scalper? If your personality falls under these characteristics. You like fast trading and excitement? Well, the Forex market can be exciting. Also, you don't mind being focused on charts for several hours at a time. So again, we're sitting in front of that computer like a hawk for hours and hours and hours, maybe 6 hours, 8 hours, 10 hours, 16 hours. But what you're doing is you're looking for opportunities. You're looking for the beginning of a trend, so you can just jump in and ride that bullish trend up or ride that bearish trend down, and then close that position to get whatever profit you can get. So that's one reason why people choose to be scalpers. And also, you're a very impatient person who doesn't like to wait for long trades. So it just means that you don't want to open a position and keep it open for months at a time. You want to get your profits now. Also, you can think fast and change bias or direction quickly. So if you've developed the skill of being able to read candlestick patterns and also learning how to draw trend lines, Fibonacci retracement lines, and using those technical indicators, you feel that you can do all of those things well, then maybe being a scalper would be a good option for you. However, you should not be a scalper if your personality fits under these characteristics. You get easily stressed in fast-moving environments. So meaning, if you get too emotional, that can cloud your judgment, and it can be very difficult for you to make wise decisions before you get into a currency pair. You can't commit several hours of undivided attention to your charts, meaning if you have a full-time job or you're a full-time student or you're taking care of your children at home, maybe scalping would not be the good option for you. So you want to invest in this market with the time that is disposable. So keep that in mind. And also, you'd rather make fewer trades with higher profit gains, or you like taking your time to analyze the overall picture of the market. Meaning, when we apply fundamental analysis in order to determine which investment plan we should go with, if you're having a difficult time analyzing the news and trying to figure out what information from this news story how this is going to affect the market, then maybe scalping probably would not be the right option for you. Okay, but if you insist on being a scalper, I have some tips for you. Trade only the most liquid pairs such as the euro dollar, pound franc, and the US dollar Japanese yen. And trade only the busiest times of the day. So what we're talking about is volatility. In order to be a successful scalper, you do need volatility. And also mind the spread. You don't want to trade a spread where the bid and ask prices are too far apart. Trade on a currency pair where the bid and ask prices are close together, because you don't want to lose your money as you open and close your positions. Also focus on one pair at the beginning. Again, you don't want to overwhelm yourself, because if you overwhelm yourself with too much stress, that can also cloud your judgment and you make poor decisions. Manage your money well, use stop losses, and major news reports can hurt you. So we have to be careful when we're paying attention to Reuters, CNN, Wall Street Journal. Any major news reports can drive the entire Forex market out of sync. Even if we are in the middle of a strong bullish trend, our technical indicators tell us that this is a for-real trend and this trend will continue for a long time. A news report can change all of that quickly, so be careful. Now, let's talk about day trading. Day trading just means you trade at the beginning of the day and you close when the day is over, and you are willing to take time to analyze the trade first, then execute it, and then as it's open, just monitor the trade closely to make sure that we're not losing too much on the trade, and also determine the possible amount of profit that we can make, because we can be high, but if we sense that there's no way we can get higher than this, maybe we should just close our position right then and there. Or if we're taking the losing end of the position and we feel that there's no way that the market will reverse itself by the end of the trading session, then we just stop our loss there. Now, if these characteristics match your personality, then day trading would be right for you. You like beginning and ending a trade within one day. So if you're the type of person that can wake up in the morning, study a chart really quick before you go to work or school, open a position, and then right before you go to bed at night, analyze the market again, and then close the position, whether we're up or we're down, then day trading would be right for you. Also, you have time to analyze the market at the beginning of the day, and you can monitor it throughout the day. So even if you have a full-time job, it would be wise for you to monitor the market just a little bit, just to see where you're going. Now, I'm not saying that the forex market is important than your job, so don't get me wrong. But to be a day trader, you should have an idea during the day how your position is doing. Also, you like to know whether you profited or lost at the end of the day. So again, you wake up in the morning, open a position. Before you go to bed, see how that position did throughout the course of the day. Now, if these characteristics match your personality, then you should not be a day trader. If you like longer or shorter term trading and you don't have the time to analyze markets and monitor it throughout the day, and you have a day job. So again, I'm not saying that the forex market is more important than your full-time job, but keep this in mind. If you're not able to monitor the market during the daytime, then don't be a day trader. Okay, so we're still going to talk more about day trading, but there are different types of day trading. So you can be a trend trader. So here we have a 4-hour chart. And notice that we have somewhat of a bearish trend. Okay, so again, we're looking at a 4-hour chart. And again, notice that the overall market is bearish. And by the way, this is a pound-dollar chart. And then here we have our two oscillators on the bottom, this RSI and stochastic, giving us some good technical analysis. Now, let's switch the 4-hour chart to a 15-minute chart. And notice that we also have a bearish trend on this chart as well. And we have our technical indicators on the bottom to confirm that bearish trend. So here, it's telling us that we should enter at this point where we can see that on the stochastic that the market is overbought, and we have a nice little crossover on the stochastic. So again, if you're going to be a trend trader, we should monitor both the long charts and the short charts and use them together. Okay, so some tips on being a trend trader. As we did before, we looked at the longer time frame to find the overall trend. Look at the longer time frame first. That way we have the big and complete picture of what's happening in the market. And then we look at the shorter time frame to find the trading opportunities. So remember, long time frame to look at the picture, shorter time frame to find a good place to enter. Using indicators on the shorter time frame also helps you to find an ideal place to enter. So again, got to use those indicators on both charts. Okay, so now let's talk about counter trend trading. So here we have the 4-hour chart on the pound-dollar pair again, and notice we have an overall bullish trend. However, at the end of the chart, we have a signal on the stochastic telling us that the market is oversold. So what do? Well, we switched to the 15-minute chart and we entered at that position, and as we can see, the market indeed reversed itself. So again, sometimes when we look at the bigger chart, the longer chart, we can see the market being bearish or bullish, but the 15-minute chart is the opposite. So that's why we use those technical indicators to confirm whether or not we have a trading opportunity. And as we can see, since the overall trend looks exhausted, you take a trade on the opposite direction on the smaller time frame. So again, we saw the bearish trend on the longer time frame, but we also saw an oversold signal. Then we went to the 15-minute charts to see where and when we can enter a long position. So we already had the idea into our minds that we're going to go long on the pound dollar pair, but where and when. So that's why we use both the longer time frame and the shorter time frame. Okay, so let's go back to the 4-hour chart. So we took a long position in the middle of the bearish trend. However, we entered when we saw that oversold signal. And here we have a nice big bullish trend even on the 4-hour chart. So that's how day traders make their profits, by taking a longer time frame and a shorter time frame, preferably a 4-hour chart and a 15-minute chart. It doesn't have to be those charts, but a 4-hour chart generally gives the trader, most traders, an idea as to what the market is doing, but the 15-minute chart can show us where and when would be a good time to enter. Okay, another type of day trading is the breakout trading. You look at the range a pair has made during certain hours of the day, and then placing trades on either side, hoping to catch a breakout in either direction. So we're going back to what I mentioned on the previous videos about the triangles. And what do we do when we see a symmetrical triangle? We set 2 orders on each side, but have one order cancel the other. So we're prepared. So again, here we have the market that is ranging. And so when we feel that one of the lines of support and resistance are about to break, we set entry points on both sides of the ranging market, on either side of the line of resistance and support. And then we set our targets based on the information that we get by using our technical indicators, and also we apply our stop losses, as we can see in this chart. Okay, now let's move on to swing trading. Swing trading is a type of trading that requires patience while holding onto trades several days at a time. And this is probably best suited for those who have full-time jobs or school, but have enough free time to stay up to date with what's going on in the world. And since trades last longer than one day, larger stop losses are required to weather volatility. So if you do have a full-time job, as I stated before, or you're a full-time student, then you might want to consider swing trading if you're willing to set aside some extra time to study the market. Okay, so how do you know if you're a swing trader? If your personality matches these characteristics. You don't mind holding on to trades for several days. You're willing to take fewer trades, but more careful about setting up each trade. So sometimes it is necessary to open up 2 or more positions, but also be careful because we don't want to be margin called. And also you are able to remain calm when trades are moving against you. So again, we're talking about keeping our emotions in check. We don't want our emotions to cloud our judgment. Sometimes the market is going against where we want it to be, but we just got to be patient and wait for the market to reverse itself. And you have a full-time job, but enjoy trading on the side. So again, we're not taking any time from your full-time job or any time from your studying if you're a student. We're talking about trading in your spare time, the time that you're able to set aside. That's swing trading. But you should not be a swing trader if your personality matches these characteristics. You like fast-paced trading. Nope, because if you're a swing trader, you're not going to see a large amounts of fluctuations. Also, you're impatient and you feel stressed when trades go against you. So again, it's all about keeping your emotions in check. And you can't spend a couple of hours every day to analyze the markets. So again, analyzing the markets is important. We need that fundamental and sentiment analysis to give us that winning edge when we are placing our trades. Now, let's talk about position trading. Position trading is the longest term trading, and fundamentals dictate the long-term trends of currency pairs. And you must make sure that you are well capitalized so you won't get margin calls. So if you're going to open up a position, keep it open for a long time. We have to make sure that our losses aren't too big, because if our losses get bigger and bigger and bigger, then we lose our capital during margin calling. And you may experience huge swings, and you must be ready and to understand your analysis in order to remain calm during the times. So if we see something in the market that doesn't go our way and we get upset, well, we have to be able to study the market to make sure that the market will reverse itself in due time, and to be a little bit more patient. Okay, so if your personality matches these characteristics of a position trader, then this should be your style. You're an independent thinker who has a great understanding of fundamentals, and you have good foresight. So you're able to understand the market and have a good idea as to where it might be in the future. Also, you have enough capital to withstand several hundred pips if the market goes against you. So again, you need to have a lot of capital in your account. You should have it in your account anyways, because because if your capital is smaller, then you get margin called faster. But if the more capital you have in your accounts, the longer you'll last in this market. So it's also important to consider how much capital you're willing to fund your account with. And if your personality matches these characteristics, then you should not be a swing trader. You easily get swayed by popular opinions, and you don't have an understanding as to how fundamentals affect the markets in the long run. So again, we're talking about patience. Patience is the key. Patience will help us learn about the market, analyze the market more, and also with patience we can gain the experience that we need, because as I said in the beginning of the video, what makes a trader great is the assets of time and experience. So we need time and experience in order to be really good at this market. Okay, so in summary, here's what we've learned. There are 4 types of traders. The scalpers. These are the people who jump in, get the quick profits, and then jump out. So that's also a good way of making sure that our losses aren't too big. However, you have to be glued to the computer like a hawk. We're talking hours and hours in a day. Also, day trading is also a good way of making profits, because we can analyze the shorter time frames on the chart, and we can analyze the longer time frames on the chart and compare that with our technical indicators. However, that also consumes a large amount of time. So that's one good thing and one bad thing about day trading. Also, with swing traders, a good thing about being a swing trader is it doesn't take too much time out of your busy schedule. However, the profits do come slow. And then also the position traders. The good thing about being a position trader is that we can take a long time to study the market to determine whether or not the trend will reverse itself if we are on the losing end, or we can determine how much of a profit we can make. And if you're a position trader, your profits are the largest. However, if you must have a large amount of capital in your accounts in order to endure the periods where your position is in the negative. Okay, so, and it's very important to choose the right style for you. So again, we need to develop our investment strategies, and we also need to develop our trading styles. We need to develop these in order to be successful traders. Thank you for watching this video, and good trading.